Hello, everybody. Happy Tuesday, Tuesday, June 10th. Welcome. Hello, Gene. Always good to see you up at the top of the stream there. All right. Quiet market again. Very, very low volume. Yes, S&Ps are up about 25 points. The Dow is up 115. The NASDAQ up 75. VIX is down below 17 again. Seems like the market is just waiting on tariff news, waiting on CPI, which we get together. Hoping everybody else can hear and see me besides Gene. Gene, I definitely appreciate you telling me that. Can everybody see me okay and hear me? We got an important one to talk about today. We're going to touch on synthetics, which we have talked about before, but how that plays into the relationship with put call parity. Thank you, John, David, Justin, Rocky Mountain High. I know I shouldn't sing. All right. So before we start, everybody, I would love for you all, thank you, Pete, and Ralph, would love for you all to, you know the drill, smash the like, subscribe, all that good stuff. It really does help us. I know I say that every day, but it really does help us. So I would very, very much appreciate it. All right. Before we get started, tonight, everybody, we're going to put thank you, Justin. We're going to put a link up here in the chat. Tonight is our monthly coaches roundtable. I touched on it yesterday really quickly. We do this every month. All the coaches get together for just get insights on everyone's mindset about what's going on in the markets, kind of review what's going on in everyone's rooms. We typically do this after the close, but we had such a decent amount of people calling in and emailing in and saying, can we do it at night like some of your other webinars rather than after the close? So tonight, 7 o'clock Central Time, the link is in the chat here, and we would love if as many of you as possible could join us all tonight, all at once. All right, let's get to this here. Okay, you hear me talking about put call parity very often. Okay, and what does that actually mean? What it actually means is that there has to be the same amount of extrinsic value or premium in the price of a call as in the price of the same put at the same strike, same expiration. Otherwise, there would be massive arbitrage opportunity. Okay, so a lot of times I will ask one of the classes and say, hey, how come there's a lot more premium maybe in this put than in, hey, Aladdin, than in the call side here? And most of the time the answer will be, well, the market's expecting that stock to go down, or volatility is higher, or there's a skew, and that is not the case. Okay, if that was the case, that exactly, David, it is not the case. If it was, we would be able to arbitrage that. Okay, and we'd be able to arbitrage that because of the synthetic option relationship. So again, what is put call parity? Okay, put call parity is a fundamental, easy for me to say, principle in option trading that establishes a relationship between call and put options, the underlying stock, and the strike price. Okay, and like it says here, in a market without inefficiencies, and we absolutely trade in an efficient market. Okay, the prices of puts and calls with the same strike price, same expiration, should be connected in a specific way. They should have an equal amount of premium to them. Okay, there should be no price discrepancy. When we talk about price discrepancy, all we're really talking about is the extrinsic value, the premium, not any intrinsic value. So how do we figure that out? Well, before we do that, and we talked about synthetics a couple weeks ago, okay, if we all remember what synthetics are, okay, synthetics are a replica of a position. So for example, if you wanted to replicate owning stock, rather than going out and buying the stock, you could just buy a call and sell a put. Same strike, same expiration. That will exactly replicate owning stock. Okay. Now, from this equation right here, from that equation right there, we can algebraically get to any of the other positions on here. So let's go right down to the bottom. Let's say we wanted to replicate a short call. Well, instead of just selling a call option, what you could do is sell a put and sell the stock. Okay. However, if the relationship between a call and a put in terms of premium, extrinsic value, was not in line, this is where that arbitrage would come in. So on this bottom one right here, let's say the short put, in this instance right here, had much more extrinsic value than the short call. Okay, I would rather take this position than just selling a call outright. It's going to get me more premium. Okay, now there are some outstanding explanations for this. A lot of you are saying dividend. That is definitely one of them. We're going to go through this. Okay, but here is really how you figure out put call parity. The call price minus the put price should equal the stock price minus the strike price. Okay, and with that algebraic equation right there, okay, that will enable us to calculate any of those four components as long as we know the other three. So if we know price of the call, price of the put, and the strike price, we can solve for where the stock should be. Okay. Put call parity also helps us understand market expectations, because if there is a significant discrepancy, excuse me, between the two, okay, that should send up the warning signals. That should send up the flashing lights, because it will indicate that there's something going on. Either unexpected volatility, which really isn't the case, because we would see the same volatility or the same reaction in both the call and the put, or there's a dividend, as many of you have mentioned, or there could be liquidity issues, meaning that the stock is hard to borrow. Okay, but if you understand the relationship, then you will ensure that you are not overpaying or underselling a put or a call. Let's go through some examples here. Okay, here is that exact formula that I just talked about. Okay, so let's say we have ABC stock, XYZ stock, whatever it is, trading at $30.50. Okay, and we're looking at the money 30 strike price, and we want to balance, or we want to compare the relationship, the pricing relationship between a call and a put at that strike. Okay, now out of these four components up here, we need three to calculate the other one. Okay, so we have the stock price, we have the strike price, and then down here In my example, I said the put is trading for $1.10. So what should the price of the call be trading for? Okay. Before we go through this calculation, let me ask everybody something. Okay. If the stock is $30.50 and we're looking at the 30 strike put, okay, how much intrinsic value is priced into that 30 strike put with the stock trading 30 and a half? How much intrinsic value is there? Okay. Love it. We got two different answers right off the bat. That is a good thing. Wow, I'm not sure where. Okay, those other ones. Now we've got 1, 2, 3, 4 different answers. 4 different answers. Okay, rather than stay on this equation here, I'm actually just going to look at something and bring it in here. Okay, I just brought in Tesla, this week's options. Okay, the stock right now is 317 and change. Okay, I'm randomly just selecting the 290 strike put, which is trading, as you can see, for about $1.20, $1.22. How much intrinsic value is there to that put? How much intrinsic value is there to that put? Okay. What does that put, Gene, allow you to do? If you own that put, what does that allow you to do? Come on, I know there's more than 3 people here, guys. Let's get some more interaction, some more answers here. Okay, got a few more zeros. Okay, Aladdin, excellent. It allows us to, no, Gene. It allows us, if I own that put, it allows us to sell stock at 290. Okay, if I own a put, it allows me to sell stock at that strike price. Okay, if this were expiration, it's not, but if this were expiration and the stock up here trading 318, would I want to exercise this put to sell stock at 290? Anybody, would I want to do that? Okay, no, absolutely not. No. Okay, so if I'm not going to do that, that means there is 0 real value or 0 intrinsic value to that option. And the entire $1.20 that is trading is all premium or extrinsic value. There's no real value to that option. Does that make sense? It is out of the money. There is no real value. Does that make sense to everyone? Okay, Jim, if I have the ability, because I own this put, okay, if I have the ability to sell stock at 290, okay, would I want to do that, Jim, when the stock is trading 317? Jim? Okay, why would I sell? Jim, are you answering yes, you can hear me, or yes, you would want to sell the stock there? Right? Why would I want to sell it at 290 when it's trading 317 in the open market? I wouldn't. Which means there's really zero real value to that put. And whatever price it's trading for, the $1.20 or whatever it is right now, that is all just premium. Yes, as long as it is not your stock. No, guys, it's irrelevant. It's irrelevant if you own stock or not. It is irrelevant. Guys, focus on the question here. Very simple question. Would I want to sell stock at 290 if it's trading 317 in the open market? Thank you, Jim. Why would I do that, Aladdin? Why would I sell it at 290 if I could sell it at 317? The answer is a resounding no. There is absolutely no scenario where I would exercise that put. Does everybody understand that? If you have an out of the money option, there is no intrinsic value to an out of the money option. There is only premium or extrinsic value. So now let's go back to our example here. Okay. If we're talking about the stock being at $30.50, what I had asked was, how much intrinsic value is there to the 30 strike put? The 30 strike is trading for $1.10. How much intrinsic value is there? Okay. Robert, Clive. Come on, guys. You're just not focusing right now. If you own the 30 strike put and the stock is trading 30 and a half, it's exactly what I said, Kevin. Okay. Would you exercise that put to sell stock at 30? Nope, Kevin, no. There is no intrinsic value to this put option, guys. Again, think about it. If I have the opportunity, because I own the 30 strike put, so if I have the opportunity to sell stock at 30, but it's trading 30 and a half, why would I choose to do that? I wouldn't. I absolutely would not. So there is zero intrinsic or real value to that option. The $1.10 that this is trading is all extrinsic value or premium. Does everybody understand that? There is zero intrinsic value, real value to that put. Okay? Now, if we know those three pieces of the puzzle, we know the put price, we know the stock price, and we know the strike price, then we can easily calculate what the correct call price should be. Okay, just simple mathematics. So we're solving for the call price. We know the put's $1.10. We know the stock is 30.50 and the strike is 30. That puts the call price equal to $1.60. Another way to think of that is if you own the 30 strike call now, not put, if you own the 30 strike call and the stock is trading $30.50, how much intrinsic value? How much intrinsic value is there? You own the 30 strike call. Stock is trading 30 and a half. What is the real value, the intrinsic value? Excellent. It is 50 cents. Bill, it is not zero. It's 50 cents. It's 50 cents because if I exercise my call to buy stock at 30 and then I can sell it at 30 and a half in the open market, it's 50 cents. It is 50 cents. Anything over that would be the extrinsic value. Well, there's $1.10 of extrinsic value. The exact same as how much extrinsic value the put is trading for. Does that make sense to everybody? Does that make sense? Okay, if there was a difference, if the call was trading for $1 or $1.20 or something different, there would be a massive arbitrage opportunity because of this equation up here. Okay, now, before we go into this part, let's go to the Hulkster here. In our word of the day, everybody get that up there, please, as quickly as you can. Parity, guys, parity means equivalency. When you hear, if you follow sports at all and you hear, oh, there's so much parity in the NFC. What does that mean? It means all the teams are pretty equal. Okay? Everybody get that up there. We'll get you on the wheel. Okay. Back to our example. I'm going to use the same example here. However, let's say that there is a dividend, because dividends and interest rates absolutely do play a factor in put call parity. Okay, we must know if there is a dividend. Okay, so pretty much using the exact same example here. Stock trading 30 and a half. Okay, we're going to look at the 30 strike options again. The 30 strike put, same thing, trading for $1.10. However, in this case, the stock is paying a 30-cent dividend. Okay, a 30-cent dividend. That dividend must be factored in if we are going to try and equate the price of the call and the price of the put at the same strike. So all it is a little different formula here to take advantage, or to include, I should say, the price of the dividend. Okay, so in the prior example, we came up with the call price, solving for the call price, $1.60. However, in this new example, same stock, same everything, just that it pays a 30-cent dividend. Including that in our equation, the call price equivalency would be 30 cents less. So if you're ever looking at a call and a put at the same strike, same expiration, and the amount of premium or the amount of extrinsic value is really off, okay, one of two things. Either A, first, the stock pays a dividend, so the options are adjusted for that, or, as I mentioned very early on, okay, then there would have to be some sort of odd liquidity issue or short float, short number of outstanding shares, meaning that you can't short the stock, you can't sell the stock. So what is something you can do instead of selling stock if you want to have a short position? Buying a put. That put will be priced more expensively if you cannot short the stock. Now, that's not very common. There's not a lot of trade, not a lot of stocks that we're trading on where that happens. But we need to know that if that call and put are not priced appropriately with each other, it's for one of two reasons. Either there's a dividend or there's a liquidity issue and the stock is hard to borrow. Okay, what I am going to do, guys, because there's a whole nother concept here that I want to bring in, and that is the impact of interest rates on put call parity. But we are going to continue this tomorrow. We will have part 2 tomorrow. We'll pick up on the dividend and interest rate discussion tomorrow. Okay, everybody? Is that cool with everyone? Let's get to the wheel. Gene, I can always have my arm twisted. I can always have my arm twisted, part 2 with 2 spins. All right, let's get going here. I think yesterday's winner, if I remember right, the first winner yesterday was not here. So on the second spin, Maria You won. So if your name pops up today and I see you on here right there, Maria, you are not eligible to win today. Here we go. Frank. Yes, it was. Thank you. It was Frank. Today, Justin, Karen. Karen, are you in the house? Karen, are you in the house? Maybe. Oh, maybe Karen tried to oh, there she is. Thought maybe you tried to slip out of class a little early without getting caught. All right, Karen, you know what to do here. Shoot me an email, prosperswag@prospertrading.com. And before we go, everybody, let me post this up here again. Tonight. Great song by Genesis, by the way. If anybody would like to join our Coaches Roundtable, that's it, Coaches Roundtable tonight, 7 o'clock Central Time. You will get all of us giving our views on the market, our updates for each room, what's happening. You'll have the opportunity to ask any questions you want. If you sign up, Clive, for the roundtable tonight, you'll get a replay. Rocky Mountain, we will go into that tomorrow. I don't want to keep everybody from what they need to do right now. Okay? All right, everybody. Put call parity. That's going to be on your minds. We will continue it tomorrow. It is super, super important to understand it. All right. Have a great rest of the day, everybody. See you tomorrow. Actually, hopefully see you tonight at the round table. But otherwise, we'll see you tomorrow.